hello, everyone. When people hear that housing inventory is finally starting to rise, the immediate assumption is that homes will suddenly become more affordable. After all, investment. One of the biggest issues in the past few years has been the lack of available properties, with bidding wars pushing prices beyond what most buyers could handle. So, the idea of more homes sitting on the market sounds like good news at first, but the reality is rising inventory doesn't automatically translate into affordability, and 2025 is proving to be a textbook case of this. The core problem is that while more houses are available, the financial barriers to entry remain just as high, if not higher, than before. The first reason is simple. Sellers are still pricing their homes based on yesterday's market, not today's reality. Many homeowners who locked in ultra low mortgage rates during the pandemic are reluctant to sell unless they get a premium price, because moving would mean giving up their cheap financing and taking on a much higher interest rate. This mindset keeps listing prices stubbornly elevated even as inventory numbers climb. Buyers see more options, but the price tags attached to those options are still beyond reach. The second factor is that rising inventory doesn't necessarily mean more affordable homes. A large portion of the new supply is in the mid to high-end range where developers and sellers can still maximize profit. Starter homes, those entry-level houses young families and first-time buyers are desperate for, remain scarce. In fact, in many markets, the share of newly built homes under $300,000 is almost non-existent. So, while headlines might boast about surging inventory, the details reveal that the types of homes most people need are not the ones flooding the market. Then there's the issue of financing costs. A buyer looking at a $400,000 home today isn't just calculating the sticker price, they're calculating the monthly payment. And because mortgage rates remain historically high, even with more inventory investment, that monthly payment is still stretching beyond what the average household can afford. This creates a frustrating situation where buyers feel like they're surrounded by homes for sale, yet none of them are realistically attainable without sacrificing financial stability. It's also important to recognize the psychological component. Many buyers have been sitting on the sidelines and waiting for prices to fall in response to growing inventory. But when they don't see meaningful price reductions, they become hesitant, worried about buying at the wrong time. That hesitation actually slows down demand, leaving more homes on the market and giving the illusion of abundance when in reality, affordability hasn't improved at all. What this all comes down to is a mismatch between supply and demand. Yes, supply is rising, but it's not the kind of supply that solves the affordability crisis. Unless we see a significant shift in either prices or mortgage rates, rising inventory will continue to look like progress on paper without truly opening the door for millions of Americans who still dream of home ownership. When people talk about affordability in housing, they often focus only on the sticker price of the home. But the real cost of ownership is determined by the monthly mortgage payment, and that number has been heavily distorted by today's interest rates. Even if home prices were to come down slightly in 2025, the higher borrowing costs are keeping overall affordability out of reach for most buyers. The harsh truth is that a house costing the same as it did a few years ago now feels dramatically more expensive, simply because financing it eats up a much larger share of household income. To understand this better, think back to the era of ultra-low rates, when buyers could lock in mortgages at 2 or 3%. At that time, a $400,000 home meant a relatively manageable monthly payment. Fast forward to today, where rates have doubled or even tripled, and suddenly that same $400,000 in property requires hundreds, sometimes even over $1,000 more every month. The house hasn't changed, the buyer hasn't changed, but the cost of borrowing has skyrocketed, making the exact same property feel out of reach. This dynamic explains why so many first-time buyers are still sidelined. Investment, it's not that they don't want to purchase, it's that the numbers simply don't work. Even buyers who have saved diligently for a down payment are finding that their money doesn't stretch nearly as far when applied to today's interest rates. They can qualify for a loan on paper, but when they sit down and calculate their monthly budget, the payments crowd out other essentials like childcare, car payments, or even groceries. This creates a growing sense of financial risk around buying, leading many to keep renting, even though rents themselves remain high. The other problem is that mortgage rates affect more than just buyers. They also lock sellers in place. Homeowners who refinanced or bought during the low-rate era are understandably reluctant to trade their affordable 3% mortgage for a new one at 6 or 7%. investment. That reluctance keeps supply of affordable homes restricted. And even though we're seeing inventory rise, much of it is concentrated in higher price tiers. The homes that would normally serve as move up options or entry-level properties remain scarce, reinforcing the cycle of unaffordability. For buyers who do push forward, this meant the higher payments drastically change their financial picture. Instead of building savings, investing, or enjoying discretionary spending, many are forced to stretch thin just to cover the mortgage. This creates financial vulnerability, especially in an uncertain economy. The American dream of homeownership, once tied to stability and upward mobility, now feels like a potential financial trap for those who enter the market without significant buffers. At the end of the day, the monthly payment is what matters most, and as long as borrowing costs remain this high, affordability will not return in any meaningful way. Until either rates come down or wages rise significantly, the math simply doesn't work for the average household. That's why, even with inventory ticking upward, when the market still feels frozen, investment and buyers are left asking themselves whether the dream of owning a home is slipping further away. One of the most overlooked forces shaping the housing market in 2025 is the role of large-scale investors and institutional buyers. These aren't families looking for a place to live. These are corporations, hedge funds, and private equity groups that see housing as a profit engine. Over the past several years, they've been buying up significant chunks of available inventory, especially in fast-growing cities and suburban areas. While rising inventory numbers might suggest that there are more opportunities for everyday buyers, the reality is that a lot of these homes are getting scooped up by entities with deep pockets, leaving regular families struggling to compete. The advantage these investors hold is clear: they operate with cash. While a typical first-time buyer has to worry about securing a mortgage approval, scraping together a down payment, and budgeting for closing costs, investors often show up with full cash offers. Sellers, facing uncertainty and wanting quick, clean transactions, are more likely to accept these deals. This makes it incredibly difficult for a family trying to get their foot in the door to win a bid. Even if they're willing to pay the asking price, the competition tilts heavily in favor of institutional buyers, distorting the natural balance of the market. Beyond the initial purchase, the way investors use these homes affects affordability for everyone else. Many of the properties purchased are converted into long-term rentals or short-term vacation rentals. This reduces the number of homes available for sale, effectively keeping supply tighter than it should be. It also drives up rents, since fewer people can transition from renting to owning. As rents rise, potential buyers have a harder time saving for down payments, which further delays their ability to purchase a home. The cycle is self-reinforcing, and it leaves ordinary buyers stuck in a loop of renting while watching investors accumulate more properties. Another layer of complexity is that institutional buyers are not limited to distressed or undervalued properties. You're increasingly competing directly in the same neighborhoods and price ranges that first-time buyers target. The very homes that would traditionally serve as stepping stones into the market are being turned into investment vehicles. As a result, young families are competing not just against each other, but against billion-dollar corporations whose sole focus is maximizing returns. This dynamic puts upward pressure on both sale prices and rental costs, even when overall inventory is on the rise. Critics argue that investors are simply responding to market demand and that they provide rental housing in communities where it's needed. While that's partly true, the scale of their activity has undeniable consequences for affordability. When ownership is concentrated in the hands of investors, the dream of widespread homeownership, where families build equity and wealth over time, becomes harder to achieve. The gap between those who can own and those who must rent widens, creating a structural barrier that doesn't get solved just by having more homes available on the market. So even with surging inventory investment, the presence of investors means much of that supply never truly reaches the average buyer. It's a quiet but powerful force that helps explain why, despite the headlines about more homes being listed, everything makes a good investment. Affordability continues to slip further out of reach for everyday Americans who just want a place to call their own. The biggest underlying challenge housing market today isn't just about how many homes are available or what mortgage rates look like. It's the widening gap between what people earn and what homes cost. This disconnect has been building for years, and by 2025, it's reached a point where even with inventory levels climbing, affordability feels like a distant dream for the average family. While wages have risen in nominal terms, they haven't come close to matching the pace of housing inflation. The result is a market where homes continue to move further out of reach, especially for first-time buyers. To put this into perspective, think about the past decade. Median home prices have climbed by double-digit percentages in many parts of the country, while wage growth has lagged far behind. Even in periods where paychecks have grown a little faster, inflation in other areas, such as food, healthcare, and transportation, has eaten away at that extra income. That leaves less disposable income to allocate toward housing. So when someone earning a typical salary looks at the cost of owning a home today, the numbers simply don't add up. The mismatch is even more obvious when comparing historical data. Just a generation ago, it wasn't uncommon for families to buy a home priced at 2 or 3 times their annual household income. Today, that ratio has ballooned to 5, 6, or even 7 times income in many markets. This means buyers either have to stretch their budgets dangerously thin or simply step aside investment. And while wealthier households or dual income families may still find a path, single income households or younger workers are left increasingly locked out. Investment. What makes this situation particularly frustrating is that higher inventory doesn't solve the income gap. A larger supply of homes might prevent prices from skyrocketing further. Investment, but it doesn't automatically bring them down to a level that matches what people actually earn. Even modest price cuts don't close the affordability gap when mortgage rates are high and wages haven't kept pace. Investment. For someone making an average salary, a 5 or 10% price drop doesn't fundamentally change the fact that monthly payments consume far too much of their income. This imbalance also has broader consequences for society. When home ownership is delayed or denied, people lose out on one of the most effective ways to build long-term wealth. Renting can provide shelter, investment, but it doesn't create equity. Over time, the wealth gap between those who own homes and those who don't grows wider. Younger generations, already burdened with student loans and higher living costs, face the risk of falling permanently behind. The dream of upward mobility through home ownership, once a cornerstone of the middle class, now feels out of reach for millions. Ultimately, until wages rise at a pace that even begins to catch up with housing costs, or until home prices correct more significantly, this gap will remain the defining barrier to affordability. Inventory levels can shift. Investment. Interest rates can fluctuate, but as long as income and home prices remain on different trajectories, the housing market will continue to be a place where many aspire to buy, but far fewer can actually afford to